When it comes to investing, it often feels like, well, like you're trying to solve this huge puzzle, right, with 1,000 pieces. We're always looking for that perfect strategy, the ideal stock pick. But what if the most important piece of that puzzle was actually you? Today, we're diving deep into a really crucial concept. It underpins, I think, all smart investing, your personal risk tolerance.
Yeah, absolutely. And we've got some excellent material to work with today, some key excerpts from Assessing Your Personal Investment Risk Tolerance. Our mission, really, for you today is to cut through the jargon, help you truly understand not just what risk tolerance is, but why it's so vital, how it changes over time, and ultimately how it should shape your financial decisions. Think of this as maybe a shortcut to clarity on a core idea.
Okay, let's unpack this then. Where do we start? We need a foundational definition, right? Because
Yeah.
risk tolerance, it sounds straightforward, but lots of people hear that and maybe think about, I don't know, wild speculation or something. What's the biggest misunderstanding there?
That's a great point. It's easy to jump to conclusions. The US SEC, the Securities and Exchange Commission, they actually have a pretty precise definition. They say risk tolerance is an investor's ability and willingness to lose some or all of an investment in exchange for greater potential returns. And that's the key. The biggest misconception is often mixing up or maybe only focusing on one of those two parts, the ability and the willingness.
Ah, okay. Ability and willingness, two different things. It's easy to see how they could get tangled up, though. Our source material really hammers this point home. So ability, that's the financial capacity side, what your bank account can handle.
Exactly. That's your financial firepower, your safety net. Can your overall financial situation actually absorb a loss without derailing your essential goals?
Got it. So what's the other side of that coin? The willingness part. That sounds maybe a bit more fun.
Right. It is. It's definitely more psychological. It's your willingness to take risk. This is about your emotional comfort level. How much market turbulence can you genuinely stomach without, constantly checking your portfolio or losing sleep? It's the difference between what your finances can handle your ability and what your emotions will let you handle your willingness.
And the source material points out these two don't always line up, right? Which is where it gets interesting.
Oh, absolutely. They often diverge. The material gives good examples. Think about a wealthy investor. High income, lots of assets. Clearly, they have a high ability to take risk. They could lose a chunk and still be fine, financially speaking.
Right. They can afford it on paper.
But maybe, just by nature, they're very risk-averse. The thought of seeing their portfolio drop significantly genuinely causes them stress. So their willingness is low, even though their ability is high. They might choose stability over potentially higher but more volatile returns.
Peace of mind is worth something, too.
Precisely. Money doesn't automatically equal comfort with risk. Now, flip that. Consider a young investor, maybe just starting out. They might be super willing to take on risk. They're eager, aggressive, thinking about hitting that home run.
Yeah, they see the upside, feel they have time on their side.
Right. High willingness. But maybe they've limited savings, student debt, big goals coming up like buying a house. Their actual financial ability to absorb a big loss might be quite low, even if they feel psychologically ready for the roller coaster.
So a mismatch again, but in the other direction.
Exactly. And what's really insightful here, the goal isn't just picking one. It's about finding that sweet spot, that intersection, where what lets you sleep at night aligns with what your finances can actually sustain. It's about realistic ambition.
Okay, so it's not just a risky or not risky label. It's more nuanced. And the source says it's like a spectrum, right? Directly tied to the returns you might expect. This risk-return trade-off thing.
Absolutely. It's fundamental. Think of it like a graph, like the source material shows. As you move along the axis towards higher expected annual returns, the line also goes up in terms of expected volatility, the ups and downs.
So more potential reward generally means more bumps in the road.
That's the essence of it. At one end, you've got the conservative investor. They accept lower potential returns because they want a smoother ride. Stability, capital preservation, that's their priority. They'd rather miss out on some gains than face big losses.
Okay, makes sense. And the other end?
That's your aggressive investor. They're actively chasing those higher returns. They understand and accept that their portfolio value might swing much more widely, maybe even drop significantly in the short term. They're banking on the idea that this volatility is the price you pay for potentially higher long-term growth.
And it's crucial for you listening to figure out where you really sit on this spectrum. Because getting it wrong has real consequences, doesn't it?
Oh, absolutely. A mismatch is dangerous. Like the source points out, if you take on too much risk, more than you can psychologically handle, you might tell yourself you're aggressive, but when a real downturn hits,
Panic sets in.
exactly. Panic selling. You see your balance dropping, and that fear response kicks in. You end up selling investments right at the bottom, locking in those losses. The source calls this one of the biggest destroyers of wealth.
Turning a paper loss into a real, permanent one and missing the recovery.
Precisely. It's an emotional reaction overriding a rational plan. We feel losses much more acutely than gains that's loss aversion. So even if you know intellectually that markets fluctuate, seeing your own money shrink can trigger impulsive decisions.
Okay, so that's the danger of too much risk. What about too little?
That's the other side of the coin. If you're overly conservative relative to your goals and your financial capacity, you might simply not achieve the growth you need. Your investments might not keep pace with inflation, or you might fall short of funding retirement, education, whatever your goals are. It's about finding that balance, enough growth potential, but not so much volatility that you bail at the worst possible moment.
Find that personal sweet spot. So how do we actually do that? How do we assess ourselves honestly? I know there are questionnaires.
Right. Many brokers and advisors use risk tolerance questionnaires. They're a useful starting point. They typically ask things like, how you'd react if your portfolio lost X%, about your income stability, your savings, your comfort with market swings. They try to place you on that conservative to aggressive scale.
But the source material really pushes for deeper self-honesty beyond the quiz, right?
Yeah.
It asks point blank, how would you really feel if your portfolio dropped 20% or 30%? Would you stay the course or lose sleep and sell? It's easy to say you'd stay calm when things are good.
But imagining it vividly, viscerally, during a hypothetical storm, that's the key. That honest gut reaction is critical. It helps calibrate your true psychological comfort, separating wishful thinking from how you'd likely behave when real money is on the line. The market doesn't care how brave you say you are.
Okay, so self-assessment is crucial. But here's something else the source highlights that's really important.
Right.
This isn't static. Your risk tolerance isn't something you figure out once and it's set for life, is it?
Not at all. That's a key insight. While your underlying personality towards risk, your innate attitude might be fairly stable, your actual tolerance can and does change. It evolves based on your life circumstances, particularly your financial ability to take risk.
So what kind of things make it shift?
Several factors. Let's break them down. First, time horizon is huge. If you're young, maybe decades away from retirement or needing the money.
You have more time to recover from dips.
Exactly. You have a longer runway. Market drops are less threatening because there's ample time for potential recovery. So generally, you have a higher capacity for risk and can allocate more to potentially more volatile growth assets like stocks.
But as you get closer to needing the money,
Right. If your time horizon shrinks, say you need the money in 5 years for retirement or 3 years for a down payment, your capacity for risk decreases. You need more certainty. A big drop just before you need the cash could be disastrous. So caution increases.
that makes sense. What else influences it?
Liquidity needs are closely related. How much cash do you need readily accessible? If you need a significant chunk of your money soon for that house down payment next year, or to cover living expenses if you lost your job, that money needs to be safe. Its capacity for risk is very low. You wouldn't put your emergency fund in volatile stocks, for instance.
Yeah, that needs to be there when you need it. No questions asked.
Definitely. But money you won't need for many, many years or perhaps ever, like funds intended for legacy or charity long after you're gone that can generally be invested more aggressively. And then there's goal importance. This one's really interesting.
How so?
It's about how critical the financial goal is to your well-being. Think about funding essential retirement income versus saving for a luxury vacation. If the money is for a must-have, a non-negotiable need like basic living expenses in retirement, or a child's core education fund, or vital medical costs.
Failure's not an option, like the source says.
Exactly. The potential downside is too severe. So you'll likely adopt a much more conservative approach for that specific pool of money, prioritizing protecting the principal. Losing 20% on your dream car fund is disappointing. Losing 20% on your essential medical care fund could be life-altering.
Wow, yeah. That really puts it in perspective. The stakes are different. But for those nice-to-have goals, maybe aspirational wealth, that's where you might feel more comfortable taking bigger swings.
Potentially, yes. If the outcome isn't critical to your fundamental security or well-being, Your willingness to take on more risk for potentially higher rewards might increase for that specific goal. So, it's clear your overall financial picture, your timelines, your immediate needs, and even the nature of your dreams. They all feed into how much risk is appropriate for you at any given time. It's dynamic.
So, putting it all together, the whole point is to match your investment portfolio to this constantly evolving risk profile, right?
That's the goal. Your risk tolerance directly informs your asset allocation, how you divide your money between different types of investments like stocks, bonds, cash, etc. The source gives examples, like a moderately conservative investor might end up with, say, a 50-50 split between stocks and bonds.
While someone more aggressive might be heavily weighted in stocks, maybe 80% or even close to 100%.
Right. And it's crucial to remember, as the source notes, there's no exact formula. It's not about plugging numbers into a calculator and getting the perfect answer. It's about finding that balance, taking as much risk as you can genuinely handle, psychologically and financially, so you can stay invested through the inevitable ups and downs and still sleep at night.
Not sacrificing growth unnecessarily, but also not setting yourself up for that panic sell.
Precisely. And the biggest payoff for getting this right, preventing those emotional mistakes. Avoiding that panic selling during a crash, which, as we said, the source calls a huge destroyer of wealth. If your portfolio aligns with your true tolerance, you're much, much more likely to stick with your plan during turbulent times.
To ride it out, which is often the hardest part but the most rewarding,
Often, yes, staying invested is incredibly powerful over the long term.
which underscores why this isn't a one-time check-in. You need to revisit this periodically, right? Especially after big life changes.
Absolutely. The source stresses periodic review. Got a promotion? Had a child. Nearing retirement. Experienced a major market swing. These are all triggers to reassess if your risk tolerance, particularly your ability or maybe even your willingness has shifted, and adjust your portfolio accordingly. Life happens, markets move, your strategy needs to adapt.
Okay, so to recap, we've really dug into what risk tolerance means, that blend of ability and willingness.
Yeah, and how it's not static, how factors like your time horizon, liquidity needs, and even how important a specific goal is can change how much risk is right for you. Understanding all these pieces really is the foundation for building an effective investment strategy that actually fits you.
It really feels like knowing yourself is the ultimate advantage here. It's not just about market knowledge, but self-knowledge.
Sure.
So as you, our listener, go about your week, maybe take a moment, think beyond just the numbers, reflect on those big goals you're aiming for. How critical are they really?
Yeah.
And how might that influence the level of investment risk you're truly comfortable embracing? It's a powerful question.
That's a great takeaway thought. And speaking of strategy, the source material actually sets us up nicely for next time. Once you have this bedrock understanding of your risk tolerance, you can explore ways to potentially enhance returns without necessarily taking on more risk. We'll dive into some fascinating techniques like tax loss harvesting, a way to strategically use investment losses to your advantage. Looking forward to exploring that.